Hello, Facebook. Welcome to the 39.6 Facebook show, coming to you live from the Monterey Windsor. Sorry for a previous outtake. This is take number 2. This is the show that talks to you about how to make your money work for you so you don't have to work for your money. Today's topic, the top 5 things I look for in real estate syndications. Take it away, Pinky.
Hey, let's get moving! Come on, and spin around with me. I love dancing. I love dancing. Dance now.
All right. Thank you, Pinky. So today we are going to be talking about the 5 criteria I look for in real estate syndications. Okay, so, and these are not in any particular order, although they mildly are. So the first thing, okay, the first thing that really matters to me in any type of real estate syndicated deal, whether it be an apartment or some other commercial investment, although at this point I've only really invested in apartments, primarily is the market. Okay, this is really number 1 amongst all things. If you are investing in the right market, a bad property can do incredibly well. Okay, so this is something that really helps lay the stage down to help make sure that your property maintains its value and has the highest likelihood of appreciating in value. So things that we look for primarily are things like population growth and job growth, which are very much correlated with each other. And when you have population growth and you have properties that cannot be rebuilt at the cost that they cost to buy, then there's value. Okay, and so you become protected in terms of the value, the rental value of the units. If your rents don't ever go down, it's hard to lose money on a rental property that you can hold for a long time. Okay, so number 1 really is the market. You may be able to get a good deal in an apartment complex in another city where the population is going down by 5% per year. It may seem like a good deal today, but over time, it could be a really bad deal. Okay, just because as the markets decrease in population, there's lower demand and the market cap rates go up, which devalues your asset. Okay, so you don't ever really want to have an asset that has a propensity or a downward force that will drive its value down. Okay, you really want to have your investments in places where you have higher likelihood of having appreciation just from the property itself. All right, and so that's the end of number 1 is the market. Saying hi to some people who are out here. Hi, Rabia. Hi, Nancy. Dinesh. Thanks for showing up. Good to see you all. Feel free to share if you know anybody else who might be interested in this. Other people who are watching, please comment. Give me a thumbs up, or my favorite would be the wow face if you see it over there. All right, so number 1 is the market. Moving on to number 2. In a syndicated deal, the number 2 thing I look for is the sponsor. Okay, so you think about the property as like the horse, and number 2 is the jockey. That's the sponsor. The sponsor is the person or group of people who are taking this asset and they're going to execute the business strategy that the goals are for this project. Okay, so ultimately, the one biggest risk in any investment like this, which is a private equity, is execution risk. Okay, the market risk is there, and you buy assets trying to mitigate market risk, but ultimately execution risk is the number 1 factor, because you design a business plan to do these renovations and increase these rents and change over this property management. Those are the things that are really going to force the value to appreciate. Okay, and so you need people who are running the ship, who are experienced, knowledgeable people. Okay, so they've done this before and they know what they're doing. Okay, they have the time and the hustle to do this. And we talked about the 5 pillars of making money last week. And those are 4 of the pillars, and the 5th being money, the initial capital injection to get the deal done. Okay, so you want people who are going to manage the asset, do a good job, and ultimately you want to work with people that you know. Okay, because when you're investing with private equities, these are not a lot of people who are investing in them. You want to know the people who are in charge of your money. Okay, I like to work with people that, you know, I have their cell phone numbers. I can call them, I can text them, I can message them at any time. Okay, those are the types of deals that are in private equities where I feel more comfortable investing my capital. Okay, and ultimately, another thing that I look for when I work with sponsors is ultimately knowing what their goals are, their financial goals are. What are they trying to accomplish in the next 5, 10 years, or 20 years, or 30 years? Okay, do my goals financially align with their goals? Okay, because they're the ones who are making the decisions about when to sell the asset. Okay, ultimately, those general partners, they make all the shots. Okay, so if you have slightly different goals than they do, you might not want to work with them in general, or maybe not on that particular deal. Okay, if you know that they don't need the cash flow, or they don't want to incur capital gains in a certain period of time, and that doesn't align with your kind of timeline, then you might not want to work with those types of sponsors. If you're working with sponsors who are retired and they just want cash flow and they don't care about growth, that's different from somebody who might be younger, working already, and they care less about cash flow and care more about long-term appreciation, protection from capital gains, things like that. Okay, so number 2 is the sponsor. All right, take another break here. Hello, Dinesh. I didn't see you earlier, so saying hi. And Lynn, oh, maybe I did say hi to Dinesh. And Bantu, good to see you guys here. Thank you very much for joining. All right, so number 3, okay, this is the property itself. Okay, number 1 is the market, number 2 is the sponsor, and number 3 is the property. Okay, now the property itself is just the asset. Okay, it is ultimately, it is your vehicle that you are using to accomplish your goals. Okay, so you want to have the asset that can do that for you. Okay, so in general, I don't invest in luxury properties. Okay, I love living in them. I don't live in Class C apartment complexes, but investing in a Class C rental property is very reasonable. Okay, it makes sense financially. Sorry. So luxury Class A properties in general, I don't invest in. They just have too much risk, and they're too correlated with the market. They're also much more likely, because they're correlated, when the market doesn't do well, those luxury properties will be the first to get hit. Because when people lose jobs, they're not trying to move into nicer places. They're moving into cheaper places. People who had homes and are foreclosing are going to apartments. Okay, so there's a downward pressure on rents. But people with stable middle-class income lives and lifestyles, they still need to live somewhere. So those properties actually can become in higher demand. Like Class B and C rentals are much more stable asset classes that I feel comfortable investing in. Now, some people make a killing investing in new developments of Class A properties, and also make a killing investing in Class D housing with Section 8 tenants. That's not where I want to invest my money, at least not at this time. I like stabilized assets that are Class B and Class C, that are rented, that they are performing. Okay, so you already have an idea of what your rents are actually going to be over the next year, because you have leases. Okay, you have tenants in place. It's a stabilized asset where you have predictable returns, but you also know that ultimately you will have opportunity to also drive up the income based on comparable properties. Okay, so you look at comparable properties, you know that you're undervalued in one way or another, and also you look at just what is the cost to build a similar structure from scratch, to buy the land and build it. If you can build the same structure at the same cost it would be for you to buy it. Well, you don't necessarily have that much room for the value to go up. Even if the market goes up, if somebody can build that same thing for a set price, somebody else can go ahead and do that. And so ultimately, they're not going to want to overpay for a used property when they could just build a new property, okay, for the same amount. So you want to make sure that you have some of that protection and price from new construction, okay? Now, factor number 4, okay? I'm going to say hi to Atul. Thanks for showing up, Atul. Good to see you here. Thank you again for your comment, Nancy. Appreciate it. Good to see you here. Number 4 is the debt. Okay, so different properties have different mortgages. Okay, so when you look at a deal, you want to be comfortable with the debt that they take on. Okay, so I see a lot of offerings that have like a 3-year note or a 3-year mortgage, and then you need to refinance it. Okay, and there are other deals where you have like a 10-year hold or a 12. I actually have one property that we assumed the original mortgage, and it was a 30-year mortgage, and we got in within the first 5 years. So there's still over 25 years on this mortgage. So this long-term note can withstand market cycles no matter what happens. As long as the property is cash flowing, I don't need to worry about that asset because the hold period is so long. Ultimately, we could hold on to it until there is no mortgage. Okay, so the risk for principal loss in that type of structure is so low. Now, a lot of people try to get higher returns in terms of the amount of cash flow you get, and they do that by getting lower interest rate loans, but often those are much shorter, like 3 years, and then you have to refinance. That to me is a much riskier proposition. Okay, especially right now, a lot of people say, you know, things are overvalued or we're at a market peak. You can believe what you want to believe, but ultimately, we have had an increasing economy for a decade. Okay, so if there is a downturn in the next 3 years, you don't want to be caught with an asset that has lost substantial value just at the time when your mortgage expires. Okay. If the cap rates go up on a property and the cap rates go up substantially, even like 1%, you can ultimately lose a lot of value on your asset, okay, in terms of having to sell it or refinance it. So you could potentially be underwater. You don't ever want to be underwater on an asset because if you are at the time when the mortgage closes, well, you basically can just lose the asset entirely or have to do a capital call where investors have to bring in more capital just to keep it afloat so it doesn't go under and you don't lose your asset. So I prefer longer holds for people who want to have more conservative investments, especially for people who have never invested in real estate before. Okay, there are a lot of pros out there who will buy unperforming assets, okay, things that are about 70 to 80% occupied. And they're going to get something with a very short-term loan because they're going to be able to fill that property with tenants within the next year as they get it stabilized and can confidently get a new mortgage. But you don't know what the interest rates are going to be in the next year or 2 years from now when that time comes. So there's still more speculation involved. So for the people who want to be more conservative, I being one of them, because I'm deploying a lot of capital pretty often, I don't need to take big risks to get big returns. I'm very comfortable with moderate risk or low risk and getting good returns. Okay, we don't need to hit home runs. We can hit triples all day long. Okay, so a long holding period really mitigates the risk of the market. The market is the one thing that you cannot control. You can control your property. That's why you have excellent sponsors. You can control what you do to it and the renovations and the property management, but you cannot control the market unless you have a whole bunch of properties in the same area. and then you can get a little bit of control. But you can't really control the economy. You can't control all the job growth, which really drives the value and the need for housing. Okay, so that's number 4: market, sponsor, property, and debt. Sorry, one more thing on the debt. A lot of loans they will get with interest only for the first 1 or 2 years, sometimes 3 or 4 years, depending on how good the sponsors are at getting a better mortgage. And so those interest only years, you're paying less debt service. So you can cash flow better on the initial holding period when you're doing all the renovations, which really helps keep your cash flow positive. Okay, so that's a nice thing, and that helps you get your capital back as an investor, because ultimately as an investor, and if you ever watch Shark Tank, Mr. Wonderful, who is the most disciplined investor on the board, he will always say, how do I get my money back? So getting your money back is your key to not losing principal. Okay, so having better cash flow is a way to secure your principal. All right. Number 5, okay, is ultimately the payment structure of the deal. Okay, so a lot of deals will have what we call a preferred rate of return. Okay, so a preferred rate of return, I did a whole segment on this. I think it was episode 11, the last one I did, or maybe episode 10. Episode 10, I talked extensively about preferred rates of return. So you have the mortgage, and the mortgage is considered debt. Okay, and you have the general partners who are taking just equity, and then you have the preferred equity, which is in the middle, and those are the passive investors. And so the passive investors who have a preferred equity share, they get the first portion of the profits, and until that preferred rate of return is completely satisfied, not until that point does the general partner and the limited partner start splitting the profits. Okay, so if you have a preferred rate of return, it's a way to help secure your investment and have more of a guarantee. There's no real guarantees, but it helps. If the property is underperforming, you're going to get more of that money at the front end. Okay, so when it's underperforming, you're getting basically all of the money. So your principal, you're getting it back to you faster, okay, than you would if it's straight equity. So preferred rates of return are fantastic for people who want to really mitigate principal loss. Other deals are straight equity deals, and you're basically giving up a portion of the profit directly to the general partners. Okay, when you do that, you are diluting your cash flow because you're giving it to the general partner. So you want to know what that split is. Is it 70-30? Is it 80-20? 85-15, 90-10. I like to have the split be on the lowest end possible as a passive investor, because you are diluted. Okay. Granted, there aren't many deals where you can get in at a 90-10 split, but often 85-15 is out there. That's very reasonable. Okay. You want to make sure that you have sponsors that are experienced and you're comfortable having basically diluted your shares by paying them directly a portion of your profits from day one. So if the property is underperforming, they're still getting paid, okay? But if it overperforms, you're going to get an equivalent share of all the overperformance. So you take on more risk on the downside and a higher share of the upside when you have a straight equity deal, okay? So those structures are very important. It's nice to have a preferred rate of return, but you also want to look at how much you're giving up on the upside. Okay. And if you're giving up straight equity, look at that percentage you're giving, because you want to make sure that, you're not over diluting yourself, which really can put your principal more at risk. Okay. Because once that's gone, the sponsor has that share, even if the property basically loses money. Okay. But they're still getting paid for that. So those are the 5 things: the market, okay, the sponsors, the people who are driving the horse itself, which is the property, and then the debt and the payment structure. Okay, so that's it for today. That's episode number 12. I'm going to answer any other questions here. We have Tool, thanks for showing up here. Frisco, greater than Dallas for your criteria number 1. That is, would percentage growth be better than numerical population growth? And cites a census link. That's a very good question. Okay, so Frisco is a sub-market, okay, of the Dallas-Fort Worth area. Okay, and Dallas is a huge city with lots of different sub-markets in it. So it's hard to compare a submarket to a big city. You can compare submarkets to submarkets, but ultimately both matter. Both the raw number of people that are moving in, as well as the percentage. So I do care about both. And ultimately, one way to look at this is the number of people per the number of apartment units, and you can get that data. That data is out there. So you could be in an area that has a good growth of, for example, apartment buildings, but there is a gigantic city. If you look at the growth per person, it's a completely different ratio. Okay, so I look at both things, and you want to make sure that there's a good need for what you have to offer, no matter where you are. We often look at percentage growth because it's a good overall marker of the entire economy, because ultimately population growth by number is just a flat constant. It's just a number. It's not relative to anything else. So if you see that there's 5% population growth, well, you know that there's basically 5% more people now in comparison to all the apartments that were there before. Okay, and so if you're investing in cities with 5% population growth, that's incredible. The way we usually underwrite these apartments is that on a year-to-year basis, the rent will go up by about 2% on average on a typical year. That's without really doing anything to the property. And that's just due to inflation. Okay, so if your property is just keeping up with inflation, the rent should go up by about 2% per year. And by definition, real estate should keep up with inflation because it's not cash. Okay. Now, in the first year that you own an asset, if you're actually going to do some renovations, or if you're going to, replace the property management with people who are going to do a better job, decrease your vacancy rates, then it's very reasonable to put in like a 5% increase in rent in that first year. But in general, you usually only use about 2% rent growth. But if the population is actually going up by 5% per year, you would expect the rent to go up also by 5% per year, because that's a percentage increase. That's relative to all of the other things out there. Now, if there's new construction, that can also affect that rent growth and make up for the rent growth. But again, that rent growth is happening. I'm sorry, the buildings that are being made usually at the Class A or luxury level, at least right now, because it's too expensive to build a Class B or C property. So if you're buying assets and you're buying the B and C properties, you get that, what we call a moat in the investing world, where it's hard to compete with it because you are a limited resource. You can't just build something to replace it. So that's a kind of a long answer to your question, Atul, but I hope it answers it for you. If there are any other questions, I'm happy to take them. Otherwise, we're going to sign off for tonight. And until tomorrow, take us home, Pinky.
Let's listen to your music. Start the tunes and I'll start to groove. I'm listening.
I hit the wrong button.
Hey, let's get
Here we go. All right, 39.6 Facebook Live coming at you from the Monterey Windsor. Think about what you can do to make your money work for you, so you don't have to work for your money.
Dance now, clap, clap. Spin around. Hands up, hands up. Yeah, clap, clap. Spin around. Hands up, hands up. That's dancing. That's how you do it.
Good night.